Welcome, Anders. It's been a few weeks then since our last update, and I guess in the good weather mood that we've had here in Sweden with the early fall and some nice sun and warm temperatures, the markets have also been in a good mood. Why do we see that they are in such a good mood?
Well, I think the basic explanation is that we've now lived through the start of the tariffs impact, and clearly it's been fairly small. US inflation in June, July and August have been contained. Clearly we don't see a big fallout in terms of underlying inflation pressure in the US. The reason for this is that a fairly large part of the US trade with Canada and Mexico has remained on the very low tariff level, so roughly 90% of North American trade has been on low tariffs. We didn't see a trade war with Europe, which also meant that inflation in the euro area is actually well contained. And on top of that, we also actually had a fairly resilient Chinese economic development during the summer. The tariffs have had an impact. Chinese export to US is cut in half, but in spite of that, we're actually seeing fairly healthy export growth. The last number was 4% year-on-year increase. So with a fairly limited impact on US inflation and interest rates, the fact that we didn't see a trade war with Europe and the resilience of the Chinese economy, I think the combination of these three factors have meant that a bit of the risk premium that we put into the market during the spring has been taken out, and therefore we've seen a pretty healthy development on the stock markets in almost all the big regions.
Mm. And since we last spoke, we saw the US cut interest rates. Do you see more interest rates, one or more, coming before the end of the year?
So yeah, I think that the Fed is in a fairly comfortable position. The US is running the economy with an open output gap, so capacity utilization is fairly small, fairly low. We've also seen the labor market cooling quite substantially, and that's also important when we discuss tariff, because a second round effect could obviously be that wages would increase in 26 as a compensation, and that seems very unlikely with the softening of the labor market. And we've also had a pretty good run on the productivity, and given that US GDP now is revisited upwards, while labor market data is revisited downwards, the implication is clearly that productivity has been very healthy in the last few quarters. And given that wages are coming down, this implies that unit labor cost is getting well in line with the inflation target. So Fed is forecasting an inflation of around 3% end of this year, and around 2.5% next year, and then getting closer to 2%. And in this type of environment, I think Fed can deliver another 3 or 4 rate cuts without in any way feeling that they are under pressure for politics and all of this turmoil that we see in the US media. So yeah, I do think that the majority of the FOMC is fairly comfortable to cut rates. They are quite likely to do that in October. We have the non-farm payroll next week, and then inflation the week after. If those numbers confirm that the US is in this type of scenario with softer labor market and fairly muted tariff impact on inflation, Fed can cut in October and then continue to cut in the consecutive meetings at the end of this year, but also early next year. So I think we are in a period where we're going to see Fed implement at least 3, 4 or even 5 rate cuts.
Okay, so we have several rate cuts coming down the road in the US. We also have some positive signals in the US, but we also know that we've seen the dollar coming down relatively. How does that translate into emerging markets then?
Well, this is actually a fairly benign environment for emerging markets. Many central banks in the emerging market countries will cut rates during the autumn and early next year. The fact that Fed is moving is opening a policy space for them. When Fed are cutting rate, we normally see a little bit of at least less dollar strength, and that also implies that monetary policy in emerging market can be more active. So Given that we have fairly contained inflation in the emerging market space, particularly obviously China, where inflation is close to zero, but also India, where inflation has come down substantially, it is pretty likely that we're going to see broad rounds of rate cuts in emerging markets. And with the dollar as a less of a restriction, I think this is a pretty good space for the emerging markets going forward.
If we go back to Europe, then we've seen some optimism for Europe, but now we're going into Q4. What do you see for Europe for growth, for opportunity, and even risks coming down the way?
Yeah, it's important to remember that growth also in Europe actually came in stronger than expected in the first half of this year. If we look at the PMI data, it seems like we have at least a soft recovery in the Eurozone, and particularly in Germany. We know that fiscal policy is getting much more expansionary next year in Germany, so that will give a bit of support. But in Europe, a recovery still implies that we're going to see growth close to 1%. We have a bit of noise in the background given the political turmoil around fiscal policy in France and also UK. But I do think that also the European economy is actually in a bit of a recovery. It's still in this trajectory of perma-stagnation, but it's at least a bit of a recovery.
And finally, I guess if we turn to Sweden, we saw the Riksbank cut rates last week, and now we're headed into the Q3 results. What can we expect here for Q3 and going forward into Q4 and 2026?
So the Riksbank implemented another rate cut. That could be the last in this cycle. I do think that there are pretty strong arguments for not going very much further down with interest rates, but obviously that's depending on where inflation and the economy is heading. The government implemented a fairly expansionary budget, which is another boost to households' consumption and investments. Given that Sweden has these super strong public finances, I don't think that's a problem. The Swedish stock market is a bit in a shadow of the weakness of the euro area. We have a large industrial sector, and many of our companies have the German speaking region as their main market, so that's a little bit of a drawback. But if we look at the major Swedish industrial companies ranging from Volvo to Atlas to Epiroc, Sandvik, they are all in a pretty good condition. They are technology leaders, strong owners. They are all forward-leaning when it comes to adopting the business model. So I do think that there is also a bit of support for the Swedish stock market.
Sounds good. And we have a lot coming up here with all of the Q3 results in the different markets. Anything you want to leave us with in terms of sentiment?
Well, I think the last quarterly result gave a boost to the market because companies delivered. First and foremost, the tech companies delivered. And we also saw a bit of resilience in sectors that we were worried about. For example, the European industrial sector. We had a pretty healthy number of results, both in the US and Europe and the Nordics from the banking side. So given that we have a pretty good development during Q3, I think there is strong reason to believe that the Q3 reports are also going to give a green signal for the stock market, and particularly if we can see the tech companies delivering on the big bets they've done on AI.
Thank you very much. We'll be looking forward to all of that and speak to you again in a few weeks.
Thank you very much.